But right now we're going to focus on CAMS. From the sidelines of the Motilal Oswal 20th Annual Global Investor Conference, our colleague Vamakshi caught up with the CAMS CFO, Charan, Sesharaman, and the Deputy COO of the company, Soumendu Ganguly. And she began by asking them about the rising SIP redemptions and net growth trends in the underlying asset base.
We are seeing a narrative of continuous growth in SIP from a gross perspective on a month-on-month basis. So it's driven by obviously the higher retail participation that we are seeing, and it's good for the entire industry because all of this is going to a long-term capital formation. On a net basis, yes, we do see some amount of redemptions that are happening from SIP, but over the last 2 years, we have seen a constant between 40 to 50% of the gross SIP staying out as net SIP. So from an overall perspective, you see AMFI numbers, it was around 23,000 crores of gross that came in the last month. And, almost 40 to 45% is actually staying back as net SIP. So I think this is still healthy growth that we are seeing from overall MF perspective. And adding to the valuation gains that you're seeing, the assets under management have seen a very, very healthy growth. Over the last quarter, we had more than 30% growth in assets, and the last year it was more than 20%. So all very good underlying, metrics for the industry for a future growth.
You have also undertaken a strategic partnership with Google Cloud to redesign your RTA platform. Now, of course, this is a long gestation project which could take somewhere around 4 to 5 years, as you mentioned in the past. But how would you transition to this? What would be the incremental benefits as well as the cost that you will incur? And what would be the subsequent impact on the margins?
So how we are looking at this project is we have thought of, we are seeing the retail participation increasing in MF. We also understand that the retail investor has very different expectation set compared to what a normal investor would see, right? And as the retail investor also experiences Zomato and Swiggy and services like that, their expectations from mutual fund business is also becoming similar. So we understand that as retail participation increases, volumes grow, the ability of the current platform to scale to deliver to those expectations may get limited. And that is the reason why we have undertaken this initiative where we are rebuilding the entire RTA platform ground up on cloud. So that is where Google comes in, and how we are thinking about it is phases where there are parts of my transaction platform where I first accept a transaction and then do validations, unit allocation, I do communication. So we'll do it in phases where of the platform onto cloud, I still continue to process and give gains. We front end of and also the time and latency benefits that I get from cloud. And it will have significant costs. The net cost of the project will be within 100 crores in over the next 5 years, and the impact on margin will be very, very limited.
Sure. And Mr. Ganguly, let's also discuss your non-MF business. It has been outpacing the growth in the MF business. Do you expect this to continue, and which part of the non-MF business is expected to drive this growth going forward?
See, in the non-MF side, we have majorly 6 businesses. We see that the top 2 ones of that, which is the KRA business and the payments business, has been growing very, very nicely over the last 3 or 4 quarters. KRA has posted a 100% YOY growth. Payments is also growing because fueled by the retail participation increase in mutual funds. CAMS Pay is a leader in the UPI auto pay segment. And fueled by SIP growth, we are seeing a very, very healthy growth percentage in the CAMS Pay business. So those 2 businesses will continue to do very, very well. AIF has been posting steady growth rates of close to 15% YOY, and we believe that that will also continue. The other 3 businesses, which is basically our insurance repository business, account aggregator, and NPS. Out of that, insurance repository business has been doing well. And we have just launched a service layer on top of the entire insurance repository offering, where we believe that it will see large retail participation and thus should be accretive to the revenue numbers as well as the margins. Account aggregator is in very initial state of growth. I mean, the entire market is trying to figure out how account aggregator will be used and what are the different use cases that account aggregator can be used for. So I think that business will take a little more time to mature. So while it has started producing revenues upwards of 1 crore a quarter, but it will take a little more time to mature up and scale in terms of revenue. NPS, the last of these 6 businesses, will take a little longer to really scale.
So just to add to that, in terms of growth, you're right. We have been the non-MF business has been outpacing the MF growth. And what was actually a sub 10% share of the overall revenue last year is now crept up to more than 13.5% of overall revenue. The stated objective of CAMS is that over a period of the next 3 years, this will get to 20% of overall revenue. And minded that this is on the back of a healthy growth that we expect from the mutual fund perspective also. So we do have high expectations of the businesses that Soumendu spoke about, should get us to a stage of 20% of overall revenue over the next 3 years.
Help us understand the margin differential between the MF and the non-MF business that is there currently. What non-MF businesses are yet to break even, and how would margins on a consolidated basis look like in FY25 and beyond that?
So, I'll just like to clarify that there are 6 businesses that we are tracking in non-MF business, the MF plus 6 strategy, and all of them are not homogeneous businesses. They have different market drivers, they have different customer, go-to-market strategies, etc. But just for simplicity of understanding, suppose I put them all in a single bucket. And we were in an investment phase on the non-MF business for the last 3 years. We invested heavily on the platform building, on the sales capabilities and the go-to-market. I think we have come to a stage where they have reached, where revenue has started to come in on all these businesses. Individual businesses, KRA is a very profitable business, and so is CAMS Pay, and AAF is reasonably profitable. We are close to break even on an insurance repository, and account aggregator is probably more than a few quarters away in terms of break even. But the margin profile on a whole for the non-MF, which was less than 10% in the last year, has crept up to close to 15%. And given that all of these are, none of these are labor arbitrage business, they're all platform-based business which show an increasing trend in profitability as and when the revenue scales up. We are confident that in the next couple of years' time, the steady-state margin will be upwards of 25% for the non-MF category.